Welcome. This is our first edition of the weekly rate update, where each week FreightWaves dives into what the rate conditions have been over the last couple of weeks and where they're likely to head. We'll talk about conditions for asset-based carriers, 3PLs, and shippers, and what's happening in the market, taking a perspective that rates are a function of supply and demand for the general freight market as well as the overall economy. This week, I am excited to talk about with John Paul, but before we get into talking about freight rates specific to the market, I think we should dive into the terms that we're going to go through on this particular show and specific contract versus spot and really describe what those mean. So contract rates are really a function of a rate that has been set for a period of time between a buyer of capacity, oftentimes a 3PL or a shipper, and a seller of capacity, oftentimes an asset-based carrier. At times, a 3PL and a shipper can actually have contract rates as well. But it's important to know that nothing in the market, except for the dedicated contract services, is really contracted. In other words, you can't sue somebody because they failed to deliver freight that they said they were going to give you if it's in a contract rate but not tendered. That's an important difference in terms of the words contract versus spot. Most shippers and most carriers intend to honor the contract rates as long as the market is stable. But oftentimes in periods of volatility, like we saw last year and we've seen this year, contract rates are oftentimes not honored. What happens is when the market conditions favor one party or the other, then those rates get rebid intra-cycle. A lot of shippers operate on annual cycles, annual bid cycles, but if the market is really soft like we see now, and it's much softer than it was last year during the bid cycle, shippers will simply give freight to lower price companies. And this is really a function of whether it's a freight broker or an asset-based carrier, just soliciting those opportunities and offer to undercut it. I use the analogy that oftentimes it's like when I have a contract rate, it's the same analogy of saying my lawn guy that I have come out, I pay him $30 every single week. He comes out, mows my lawn for $30, and things are fine. But this actually happened to me. Was a golf course opened up down the street. All of a sudden, my lawn guy was not available for a few weeks. He had to take care of his family.
Did you sue him?
No, I did not sue him. But I found out he was working at the golf course.
Yeah.
He never showed up again.
Yeah.
I've also seen situations where when I had a house in Texas, my neighbor's kid was off high school for the summer, and he was willing to do my yard for $5. So naturally, I took advantage of using him. And that's really how the market works. Kid goes back into high school, I'm now paying the $30, I'm paying $5 during the summer. Right. And that's really the way the freight market works is, that was a contract rate for both the lawn guy and the kid, but at the time it's not contracted in terms of something I could sue.
Yeah, and that's kind of a lot of what we're seeing right now, Craig. The brokers I've talked to in the past few days have said that whatever tightness in capacity, whatever firmness in rates that emerged in June, especially after road check week, has really fallen away.
And you're talking specifically about the spot rate, right?
I'm talking about the spot rates, but the shippers are aware of the spot market and they're also reacting to it.
And spot rates are really a function of stuff that's bid upon the load, right?
Yep.
Typically, if you think of spot rates, it's 2 to 3 days out. I'm getting a quote at the point of tender or within a few days of tender. And basically it gives me the opportunity to move with the market, right?
Yeah, they call it like the day of market, the next day market, the 2-day market.
And so those things are really a function of what's it cost right now. Not what it's likely to be in a month, but what is it actually going for?
That's right.
And typically we see that's how brokers buy a lot of the capacity, is they actually are buying it on the spot market.
That's correct. And spot rates are falling back down. Interestingly, they said June was
Tuesday, by the way.
So brokers based in Chattanooga and Chicago that I've interviewed over the past couple of days, anywhere from 100 million revenue to 40-ish million revenue. They said that June was a complete disaster.
And they're talking, why was it a disaster?
The FMCSA inspects a lot of, they have the blitz, the road check week that removes a lot of capacity from the market. Drivers don't want to subject themselves to unpredictable inspections and fines, and so they just simply don't drive.
So we didn't have capacity in the month of June.
Yeah.
Which drove the spot rate up.
Right.
And brokers had fixed rates or contract rates with their shippers.
Right.
So we saw compression happen in margins, right? Which is really
the cost of the brokers go
all
up.
brokers really care about at the end of the day is that spread, right?
Is the margin.
Buy and sell.
Exactly. And
normally so in June they actually saw spot rates go up against a fixed rate, right?
That's correct. Now, normally a freight broker wants to maintain about a 15% gross margin, the difference between what they're selling capacity at and what they're buying it at. We heard from brokers that in June, they were happy to clear 4% gross margins.
And that's simply because there was less capacity in the market.
Yeah, it was hard for them to find trucks.
Contract rates, to use parentheses, were set, right?
Right.
They had rates on file, spot rates go up, really compressing their margin.
And now what's happened, what I've been hearing at least in July, is that capacity has returned to the market. Spot rates are back on their way down, but what's more important is that the shippers are aware of this situation and they're chasing them down with the contractor, the so-called contract rates.
So what we're seeing is that we had a tough margin environment in the month of June.
Coming from the supply side.
Because there was less trucks on the road to take loads.
Yep.
And then in July, and in moving forward, you think for the next couple of weeks, right?
Yeah, definitely. So
in July, what we're seeing is we're seeing
lower rates, which should
lower
widen.
Spot rates because there's more trucks.
Yep.
At a time when shippers are wanting reduction in those contract rates, right?
That's exactly right. I talked to a broker yesterday, a Chattanooga-based broker, who said that his customers have come back to him on lanes that he's already been awarded, so-called contract lanes, and they're asking for price reductions. And he said that he had to give up 500 basis points in gross margin to keep the business.
What's a basis point?
A basis point is 1/100%. And so basically 500 basis points is like 5%. So not a 5% reduction though in the overall margin.
It's basically, if you think 15%, it's a third.
Yeah, it's a
of
third.
His margin. He had to reduce a third of his margin.
Yeah. So he went
which is really his net revenue, right? At the end of the day, it's not even his profit. It's his it's profit on the load, but it's his net revenue.
Yeah.
So it basically means a third of his net revenue just completely wiped out.
It's hard to make money on 10% margins.
So we look at July. July has soft spot rates. Shippers will be a little bit slower to react to market conditions, even if they're chasing rates down. They're just naturally slower. And so we're seeing compression in the market. That has to be pretty tough for the asset-based carriers that operate in this market.
It is, and analysts like Deutsche Bank and Morgan Stanley looked at the June data and sort of were optimistic about it. They said maybe things are firming up, maybe capacity is starting to inflect, maybe this could be good for truckload carriers. But we're not really seeing that from our channel checks.
Deteriorating market conditions. It strikes me as interesting when we think about contract cycles. Is June is the peak of the year. Yeah. I mean, you have a lot of stuff happening, construction, production, you have agriculture, produce, whatever. June is always a peak of the year. You have another sort of mini surge on the retail season for peak as well. But that June cycle is really sort of the peak of it. I suspect that shippers that had seen the conditions were less likely to pursue significant rate reductions just out of fear that things may deteriorate. I think that their capacity availability may deteriorate, that they wanted to maintain the capacity map so that they wouldn't be in a disruptive cycle. They waited until after July 4th and said, it's time for me to rethink my business. And I think that's what's happening. That's why that word contract rate, or that word contract, we're seeing a decline. At least in theory, that's how I would see it.
Yeah, the contract rates always move. They always mark to market in a way, right? They're paper rates.
Yeah, so they're not really contracted. So if we look at what's going on right now, we've seen deterioration in shipper sentiment, or at least concern about capacity. We've seen deteriorating spot rates. You're seeing compression. It's got to put the asset guys in trouble. It also potentially could pressure brokers.
It does. It does.
But but not if the margins are held and it pressures their margins. But if we see a decrease in spot capacity, if there are bankruptcies or a lot of stuff happening, we could see the spot rate happen at a time when shippers are still thinking the market's headed down. Is that what you expect?
That's the danger, certainly, a mismatch between what the shipper's view of the market and sort of the underlying conditions. I mean, that's really where brokers can get squeezed. I've heard that mid-size and large brokers both are being super aggressive when they're having to rebid for these so-called contract lanes. And sometimes they're offering rates that are so low, they find out they can't actually cover the freight. And a broker I talked to said that he lost a lane, and then the shipper came back to him and said, "Hey, we went with the lowest bidder, and they couldn't move they couldn't move the freight." So that's how. I mean, they're really searching for the bottom of this market, and looking at the forward curve.
What's a forward curve?
So the forward curve is on our trucking freight futures market through the nodal exchange, and basically what the forward curve is, it's monthly contracts for average spot rates going into the future, going 18 months out into the future. So there's a July contract, an August contract, and people can bid on those contracts now.
And why would they do that?
To try to lock in their rates.
I mean, speculation is certainly one piece of it, but it's a hedge, right?
Yeah. So for example. If you're a carrier and you're worried that, if you're listening to us right now and you think, rates are going down, you might try to lock them in where they are right now.
It strikes me as actually, based on the conversation we're having today, that brokers actually have the biggest to lose in this environment, because if they've gone and chased those rates down and we see a V-shaped recovery in the market, we see this bounce in spot rates, that they may not get the chance to actually increase their contract rates. It may squeeze their margins pretty aggressively.
Yeah, and so a 3PL or a broker could use trucking freight futures to guarantee a price to their customers, and then if it moves up or down on them, they're protected.
Exposure. Essentially, they're protecting themselves from that rate run up.
Right.
And
so right now, if you look at the prices of the contracts going forward, in the shape of that curve, it looks like there's going to be a bottom in August at around 143 a mile
for the national long haul rate.
National long haul dry van average. Yeah.
So $1.43. And when do you think that's going to be? Is it going to be mid-August, late August?
I think late August. I definitely don't necessarily see signs of any kind of tightness really and through September, unless there's a weather event.
Yeah, I mean, if you look at historical patterns, what you typically see is that week before Labor Day, that last week of August, is about the start of the fourth quarter peak, or that retail peak season.
I see.
Because what happens is a lot of the capacity moves into Labor Day, they leave the market, and shippers start to think about the season. Halloween for retail is sort of a hot market. People are back to school, so they, there's a lot happening in the economy, and then you move into fourth quarter peak. You're moving into the retail season.
Right, and I mean, there's a rule of thumb, right, that if you want your product on shelves by Black Friday, it needs to be like on shore by September, and so that stuff has to kind of move.
So JP, real quick, if you're a freight broker right now in the market, and you're getting calls from your shippers, and they're saying, "Hey, I need you to match this rate," how should they be thinking about that, and what should they do to protect themselves?
I think you just have to talk to your customers. You have to educate them about the market, tell them what you're worried about, what you're seeing, and basically just say, like, look, we want to have a sustainable relationship. There's a lot of mixed signals in the economy. There's a lot of mixed signals in the freight market. We don't necessarily know what the fourth quarter is going to look like. And if you want to have a productive partnership, let's do that, and we can be there for each other. But trying to find the lowest cost in the market every 30 days or 60 days is not going to give you capacity when you need it.
For shippers, because ultimately the cost of paying a couple more pennies a mile is less expensive than shutting down a plant.
Yeah.
And that's the thing you have to think about from a risk management. Well, JP, it's been fun on our first edition of the weekly rate update. I'm excited to be here. It's weekly freight rate update, right?
Weekly rate update.
It's the weekly rate update, I think sounds better. And we're excited to have you. We'll be back next Friday to talk about what we saw over the last few weeks and what we're going to expect going forward. Tune in right here on FreightWaves.com for more updates. I'm Craig.
And I'm JP.
We'll be back.